Hi there, this is Alvin from Dr. Wealth. Were you one of those who bought treasury bills last year because the interest rate has gone up? And I also did a video to share that you can actually use CPF to buy treasury bills that were yielding more than 2.5%. So it makes sense for some of the people with excess CPF funds to buy these treasury bills. But now, fast forward to today, the treasury bill yields have actually came down. And yet there is a new opportunity that came out, and that is to buy a longer term bonds. And in this video I'm going to show you how and show you why you might want to consider buying these long-term bonds with CPF funds. First of all, this is the yield curve in Singapore. Let me blow it up for you. And this yield curve, what it shows is that the longer term rates have actually gone up, right? You can see in the blue line versus the orange line and the green line, which were 1 month and 6 months ago respectively. So you can see that the shorter term rates, right, within the 1-2 years, the interest rate has not really gone up. It has stabilized for the last 6 months. But the longer term rates, as you can see from about 10 years onwards, okay, there is a big jump from 2+% now has gone above 3%. So what this means is that you can now lock in a higher interest rate for a longer period of time. And especially if your CPF money is going to stuck there for maybe 20-30 years before you retire, that you can withdraw the money out, you can actually invest in these long-term bonds and get extra returns out of it. So you can see now the 10-year bond is at 3.29% yield, and versus your CPF of 2.5%, that is a significant increase of 0.79% in this case. And next, this is the table to show you the latest price, right, as of 12 September 2023. And I just want you to focus on the last column, right, column on the rightmost and the row on the bottom. And you can see that the yield is actually at 3.25%. And of course, this yield may fluctuate depending on the price you buy the bond. And this bond, SGS bond, is traded on the SGX with a ticker with a name NZ13100V. Okay, don't ask me why do they need such a long label name that nobody will remember. But that is the latest 10-year bond that we can use as a reference. Of course, some investors would point out that it is different when you buy a bond because CPF is a compounding interest kind of mechanism, which means that your principal gets that 2.5% on the following year, but the bond doesn't work that way, right? Your principal don't change and the interest is flat at 3.375% coupon rate for this 10-year bond. But let me do a calculation for you. You can see that on the left table, that's where the CPFOA at 2.5%. Assuming you have $10,000 inside and compound over the next 10 years, you end up with $12,801. So assuming you use this $10,000 to buy a 10-year bond at a yield of 3.25%, okay, so you can see the principal doesn't change, it's still $10,000 throughout, right? And of course I simplify this. It is not the case in reality because the bond price will fluctuate when interest rate changes. So it will not stay at 10,000. It can be below, it can be above, but definitely if you hold to maturity, you will get your $10,000 back. And the interest will earn interest. Why do I say that? Because when the bond pay out a 3.25%, which is $325 a year, that interest goes back to your CPF account. You cannot just withdraw it as cash and spend it, okay? So the money, the interest that is paid has to go back to the CPF account. And once it goes back to the CPF account, it starts to earn that 2.5% again. So the interest has that compounding effect inbuilt in it because the interest keeps going back to the CPF account on a yearly basis. So assuming the first year you don't earn interest on that first $325, but subsequent years you will earn that interest on interest, right? So altogether by the 10th year you will have $13,641, and that is about $800 more than if you just leave the money in CPFOA. So you might see that, okay, the amount is not significant, but this is just based on $10,000. Of course, you put more, the difference will be a lot bigger. So that is how you can increase your interest rate in your CPFOA by taking this move. So since the bond is traded on SGX, you can actually use your CPF account to buy the bond, but of course there is an issue. The issue is that typically the liquidity is very low. There's no transaction. By right, there's supposed to be a market maker to buy and sell with you, right? But we can see from this case, there's really no volume that is transacted for the past since the start of the year for this particular bond, 10-year bond that is traded on the market. And the last trader is actually $111. So that's way higher than what was shown in the MES website of 101.02, because that was based on the bid price. But the last done was actually at 111. So which means that you will not get a 3.25% yield, right, if you buy at $111. And that is if you can even get some of these bonds traded in the first place. So what can you do is that you can always go to the auction market to buy you can always go to the auction market to bid for new bonds that are being released, right? So this is the schedule so far this year. Each month there's a new bond that is going to be auctioned out, and of course you can use your CPF to apply, but you need to go to the bank branches to do the application. So for example, in January they launch a 10-year bond, in Feb they launch a 2-year bond, in March they launch a 15-year bond. Of course it depends on the tenure that you want to look at, and the next up and coming one is a 30-year bond. Okay, so if let's say you have that horizon, right, maybe you're in your young 20s and it's unlikely that in the next 30 years you're going to see your money or take your money out from the CPF or use it for your housing, then you can consider taking such a long tenure bond. Okay, because even if it's 30-year, as we see the yield curve just now, the yield is still more than 3%, right? So you will still beat the CPFOA returns in the long run. So if you don't want to do this 30-year bond, then of course you wait for the next month and see whether a new 10-year bond is going to launch. Okay, if that 10-year is that 10-year you're looking at. Otherwise, you can also go for shorter, like 5-year. So all of them are above 3% yield at this point in time. Of course, the longer you wait, we don't know what happens to the interest rates. The yield curve may shift, right? But as of now, the long-term rates have gone up, which is a good thing for investors to look at such long-term bonds. So now I want to share with you the risk, right? Every investment comes with risk, and the very first one is that let's say you need the money before the bond mature, right? Because when you buy the bond, your intention is to hold until maturity instead of trying to sell the bond in the middle of the tenure, because if you do that, the price may fluctuate. It might go below the price you paid for the bond. So if that's the case, you will lose money. Right, so there is a risk. Okay, so if you really want to invest using your CPF money, you really have to make sure that you don't need this amount, because a lot of people do use it for housing. Okay, so that's a key consideration that you want to have. And second is that interest rate might go higher, right? So maybe you lock in a 3.25% now, but a few months later it goes to 3.5%. Okay, so you might feel that, oh, I know I should have waited and locked in a longer period subsequently, right, or higher rates. But how to mitigate this is that if you believe that interest rate is going to go higher, one way is that you can build a ladder, right? So you can buy at a smaller tranche for now, right? And if the interest rate goes higher, you can add on the new bond and a higher interest rate. So that's another way to mitigate this interest rate risk. And lastly is like, if let's say this interest rate is going to stay high for a long time, there is a chance that CPF may also raise the base rate, right? So if they raise the base rate, then the gap between your interest rate from the bond and the CPF rate might narrow. That doesn't make a difference whether you buy the bond or you just leave your money in the CPFOA. But I think that is unlikely, because the CPFOA interest rate is benchmarked with the bank interest rate, the base interest rate, and the bank base interest rate has not really gone up, right? Even though the general interest rate has gone up, but the base interest rate still stays more or less the same. So I believe that the CPF rates are unlikely to change for the ordinary account. And point two also, I don't think it's likely for interest rate to go up a lot higher, right? So we are probably closer to the peak interest rate than ever before. So if you want to wait, actually the risk is more of interest rate going down rather than it's going up. So although there are risks, we also have to assess the probability of some of this risk. And lastly, the message is that long-term rates has gone up, and this become an opportunity, because initially last year we saw interest rate going up was more impactful to the short-term rates, and a lot of people rush to buy the T-bills. But the problem with T-bills is that 6 months later you will mature, or 1 year later you will mature. You need to keep renewing, and as of now the interest rate has fallen, right? Last year you still can get more than 4% interest, but now it's below 4%. So then you have this interest rate renewal risk, right? It's actually gone lower. So then you can't really enjoy a long-term rates. But now that's a different case, because the 10-year bond, 20-year bond, 30-year bond, or even up to 50-year bond, the interest rate has gone up above 3%. So the attention now can shift to the longer term bonds, where you can lock in a higher rates for a longer period of time. and you can beat your CPFOA interest rate by looking at these long-term bonds. So the second thing is that the guarantor for CPF as well as the SGS Singapore government bonds are the same, right? It is the Singapore government at the end of the day, and which means that by using CPF money to buy bonds, these government bonds, you're not taking more risk. Okay? It's the same amount of risk, yet you're getting same returns, and that is why I think this is a very comparable benchmark to use, and this is something that you can consider. Of course, it takes a bit more effort to do some of this buying. And lastly, as I said, you must remember not to be in need of this CPF fund if you decide to invest in the bonds, because you don't want to end up in a case where you want to maybe buy a house and you need more money, you need to liquidate this bond, and if the interest rate go up further, you might have to sell the bond at a loss. Okay, if interest rate go down, you will be able to sell the bond at a profit. So there is this pricing risk that may happen, so you don't want to be in that situation. So the best is only invest in these bonds if you really don't need the CPF money for any scenarios. Hopefully you find this video useful. Give me a thumbs up, subscribe to the channel, and I'll see you in the next one. Goodbye.